Welcome to Trading Intelligence LLC. In this video, I will walk you through the similarities and differences between ETN and ETF and what you need to know before you invest in ETNs. Exchange-traded note is a senior, unsecured debt security issued by a bank, which tracks an underlying index of securities and trade on a major exchange like a stock. In contrast, exchange-traded fund is a type of security that tracks an index, sector, commodity, or other asset, but which can be purchased or sold on a stock exchange the same as a regular stock. There are a few similarities between ETN and ETF. Firstly, they both trade on the major exchanges just like stocks. Secondly, they are designed to track underlying asset. Thirdly, both of them have lower expense ratios than actively managed mutual funds. Lastly, they can be purchased through traditional brokerage account and on margin. However, ETNs are distinguished from ETF in a few ways. The first difference is their characteristic traits. Just like a bond, ETN can be held to maturity or bought or sold at will, and if the underwriter were to go bankrupt, the investor would risk a total default. On the other hand, like a stock, ETF is a basket of securities that trade on an exchange, and it can be structured to track anything from the price of an individual commodity to a large and diverse collection of securities. Also, ETNs and ETFs have significant difference in risks and tracking errors. ETNs are subject to both market risk and the credit risk of the investment bank issuing the ETN, whereas ETFs are only subject to market risk. The price of the ETN tracks the index closely, but tracking errors happen if there are credit issues with the issuer. Because of expenses, investors will notice some amount of divergence from the index they track, making the fund underperform the index over time. Trading activity for ETNs can be low or fluctuate dramatically, so investors who sell an ETN before maturity can realize a large loss or gain. ETFs have much higher liquidity. For example, the SPDR S&P 500 SPY ETF, by contrast, has an average daily volume of over 168 million shares. The ability to escape the short-term capital gains tax is one of the most compelling benefits to ETNs. When the investor sells the ETN, the investor is subject to a long-term capital gains tax. With conventional ETFs, a long-term holder would be subject to capital gains tax each year. ETFs pay dividend or interest rate that is subject to short-term capital gain tax. Here are a few key takeaways for this video. ETNs are unsecured debt securities that track an underlying index of securities. ETNs are different from ETFs, which also track an underlying index of securities, but trade like a stock. ETNs bring some credit risk that ETFs don't have, while ETFs bring tracking risk. The tax treatment of ETNs is better than that of ETFs, as they are taxed at the long-term capital gains rate more favorable than that of ETFs. The default risk inherent in an ETN makes ETNs a fringe holding for most investors. It could be very risky to build an entire portfolio of ETNs, but ETNs are good investment alternatives to diversify your portfolio. Thank you so much for watching. If you like this video, please like and subscribe to our channel.